At the end of the day, CRS is here to stay.
All jurisdictions are deemed to be reportable.
FSC will be concerned by the Common Reporting Standard.
The whole point about the CRS is that exchange will become automatic.
The damaging effect of such exchange of information can be assessed.
Hello and thank you for tuning in. I'm Joanne Haig, Head of the Tax Practice at Juristconsult Chambers. We're pleased to launch our first tax webcast on CRS today. The topic we've chosen is the infamous CRS, the Common Reporting Standard for Automatic Exchange of Information, the grandchild of FATCA, if you will. Over the past couple of months, we've received a great number of queries on the application and implementation of CRS. I think it's fair to say that the initial announcement by the MRA that the implementation date would be the 1st of January 2016 sent a wave of panic across the industry. Many financial institutions argued that the industry was simply not ready to comply with CRS for a number of reasons. First, while it's very similar to FATCA, it's broader both in its technical and geographical scope. FATCA was based on citizenship and CRS is based on residence. Second, the OECD rules contain some limited flexibility for the participating countries. The draft MRA guidance was only issued at the end of November, leaving people with very little time to comment on the guidance, digest the information, and implement the procedures in time for 1st of January 2016. Finally, many institutions had not had the need to put sophisticated systems in place for FATCA because they just didn't have US clients. In other words, legislation was not relevant to them. When it comes to CRS, it affects everyone and one has no choice but to comply, but with very little time to do so. The decision by the Ministry of Finance to postpone the effective implementation date to 1st of January 2017 was therefore a much welcome one. This will give time for stakeholders to be consulted and comment on the guidance, and time for all parties affected to understand the rules and implement them correctly. This postponement will also put Mauritius at par with other competing financial services hubs, such as Switzerland and Singapore, and in my view will prevent panic redemptions and exits from Mauritius. Having said this, we must not rest on our laurels. The postponement has merely bought us some time, and it is our responsibility to use that time wisely. At the end of the day, CRS is here to stay, and it's therefore crucial to have a good working knowledge of what it entails. So today's webcast is broadly divided into 3 sections. First, my colleague Alvin Akori will outline the core framework of the CRS rules, how it operates and who it affects. Next, I'll be discussing some of the interesting issues raised by CRS, with particular focus on the Mauritius context. And finally, we will have exclusive interviews with a number of players in the market. So sit back and enjoy.
As Joanne stated, I will look at the core framework of the CRS. A central part in the operation of the CRS is for a reporting FI to collect and report relevant information. So the first question we would ask ourselves is, who is a reporting FI? This is a 4-steps test. To answer the question, we would need to ask ourselves 4 sub-questions. Firstly, is it an entity? If the answer is no, no reporting is required. The reporting obligations under the CRS applies only to entities, irrespective of the form that they take. For instance, it applies to corporations, partnerships, trusts, and even foundations. The second question out of the 4 questions is whether the entity is in a participating jurisdiction. The general rule is that entities resident in a jurisdiction and branches located in that jurisdiction are covered by the CRS. Similarly, entities in non-participating jurisdictions but with branches in participating jurisdictions are covered by the CRS. To determine the residence of an entity, if it is tax resident in a participating country, the answer is straightforward. If the entity is not tax resident, then we would need to look at its place of incorporation, or where the control and management of that entity is, or where the financial supervision of that entity is carried out. As regards trust, a separate test is provided by the CRS to determine residency. A financial institution is very widely defined. It includes a depository institution, which are saving banks, commercial banks, credit unions, custodial institutions, which include banks, brokers, and central depository for securities, investment entities, which include investing, reinvesting, or trading in financial instruments, portfolio management, or entities which administer or manage financial assets. It also includes specific insurance companies like life insurance companies. The next question is whether the entity is a non-reporting FI. It should be noted that there are a few FIs which are considered as non-reporting, like government entities, central banks, qualified credit card issuers, and generally low-risk FIs. After these 4 questions, we now know who is a reporting FI. So reporting FI are required to review the financial accounts they maintain to identify whether any of them need to be reported to the MRA. So here the reporting FI would need to identify financial accounts. What is a financial account? It is an account maintained by a financial institution. The CRS goes on to provide those specific categories of accounts like depository accounts, custodian accounts, equity and debt interests in certain investment entities, cash value insurance contracts, and annuity contracts. There are certain accounts which are considered as excluded accounts in view of the low risk of them being used to evade taxes, like retirement and pension accounts, escrow accounts, and term life insurance contracts. Each jurisdiction may have its own specific rules regarding the classification and maintaining of accounts, having regard to their legal, administrative, and operative frameworks. So now that the reporting financial institution has identified the financial accounts, they are required to review these accounts to identify whether they are reportable accounts. And if they are found to be reportable, information in relation to these accounts would need to be reported to the MRA. What is a reportable account? The test is a 2-tier test. We should first ask ourselves if the account holder is a reportable person. If yes, the account is reported. A reportable person is an individual or an entity which is resident in a reportable jurisdiction for tax purposes. In other words, is the person resident in a jurisdiction which is also implementing the CRS? Under the draft MRA guidelines, all jurisdictions are deemed to be reportable to avoid FIs having to repeat the due diligence exercise every time a new country is added to the CRS list. If no, we would then ask if the account holder is a passive non-financial entity which has one or more controlling persons as reportable persons. If yes, the account should be reported. You may be asking yourselves what a passive non-financial entity is. Well, it is an entity which receives passive income or primarily hold assets that produce passive income, like dividend or rent. Now, to ascertain if an entity has one or more controlling persons, we must look through the entity and identify those controlling persons behind the entity. Controlling persons would include beneficial owners, persons exercising control over the entity, or those persons with a controlling ownership interest in the entity. For a trust, a controlling person would be the settlor, the trustees, the protector, the beneficiaries, and any other natural person exercising ultimate effective control over the trust. So once we have a reportable institution with a reportable account, the account should be reported. There are detailed rules of due diligence which would apply to identify which information would need to be reported. This would depend whether we are dealing with a pre-existing account or a new account.
The first issue I will discuss concerns management companies, and the question is, what are the reporting obligations of a management company under CRS? Now, for the purposes of this question, I am not dealing with management companies in their capacity as trustee of trusts. Different rules apply for these. Is a management company NFI for CRS purposes? The answer isn't straightforward, and ultimately, it depends on the scope of services that the management company provides. They might not all be the same. Ideally, the MRA guidance would address the question, but to date it doesn't. Let's look at a typical management company who would incorporate and administer JVCs, funds, trusts, and foundations. There are basically four types of FIs. The first category is a depository institution. This category is essentially aimed at banks and other deposit-taking institutions. A management company would not typically fall in this category. The second type is a custodial institution. This concerns custodians, in other words, entities which hold assets on behalf of other persons. A management company, unless it also holds another license, wouldn't typically fall under this head. The third type basically concerns insurers. Again, a management company wouldn't be concerned with this. Now let's look at the fourth category, an investment entity. This is very widely defined in the legislation. I think it's worth spending a few moments looking at the definition in detail. The term investment entity includes two types of entities. First, entities that primarily conduct as a business investment activities or operations on behalf of other persons, and entities that are managed by those entities or other FIs. It's the first paragraph that would be relevant to MCs. So what are those investment activities? This is very widely defined. So what do we have? We have trading, we have individual and collective portfolio management, and otherwise investing, administering or managing financial assets or money on behalf of other persons. I repeat the third paragraph again. Otherwise investing, administering or managing financial assets or money on behalf of other persons. We're not just talking about managing here. The word administer is also used, and this is a really wide term. I believe the better view is that a management company would fall under this third section and therefore be an FI for the purposes of CRS. The next million-dollar question, therefore, is what reporting obligations do MCs have? The next step is for the FI, i.e. the management company, to review its financial accounts and determine whether it maintains any reportable accounts. So I'm sure you agree there must be financial accounts in the first place. This is a crucial step and will determine whether or not an MC will actually have anything to report in practice. There are essentially four types of financial accounts. Whether or not a MC maintains any of these accounts will depend on how their business is structured and run. If a management company determines that it does not maintain any financial account, then effectively it has no reporting obligations. The MRA guidance helpfully clarifies that FIs who have no reporting obligations do not have to file nil returns. This will lighten the administrative burden for a lot of FIs out there. As I alluded to at the start of the webcast, one key difference between FATCA and CRS is that CRS is based on residency, not citizenship. Its main aim is to combat tax evasion and catch people who shirk from their tax responsibilities in their country of residence and hide their money offshore. But let's look at how it affects Mauritians. If someone is a Mauritian and resident in Mauritius, how does CRS affect him or her? If that person has bank accounts or assets in another jurisdictions, for example France, the French tax authorities will report on him to the MRA. The MRA will in turn then verify whether the Mauritian resident has accounted for all his income and paid his taxes accordingly. Now, if someone is Mauritian and is not resident in Mauritius, how does CRS affect him? If he or she has assets in bank account in Mauritius, the Mauritian bank will need to report to the MRA, who will in turn report to the tax authorities of the jurisdiction where that Mauritian is resident. To continue with the example of France, Mauritians who are resident in France but have accounts and assets in Mauritius will need to show that they have paid their taxes on their assets in Mauritius. This is obviously the general rule. There are exceptions and exemptions that apply depending on the particular fact pattern. The concept of passive NFFEs is a very important one. The basic idea underpinning CRS is for FIs to report on their non-resident account holders. But what if the account holder is an entity? That's where the concept of passive NFFE comes into play. It effectively requires the FI to look through to the ultimate natural controlling person of the entity. Typically, that will be the person that owns more than 20% of the entity. So, for instance, a bank would be required to inquire on the tax resident of the controlling person of a GBC1, which is an investment holding company. NFFEs are not just corporate entities, they can also be trusts and foundations. The application of the due diligence rules are even broader for such entities. For example, in the case of a trust, the controlling person will be the settlor, the trustee, any beneficiary. It will therefore be very difficult, if not impossible, for people to now hide behind complex trust structures. Again, there are certain exceptions and exemptions that apply depending on the facts and circumstances. Another key difference between FATCA and CRS is that FATCA imposed a withholding tax of 30%. There are no withholding taxes for CRS. However, CRS is law in Mauritius by virtue of an amendment recently made to the Income Tax Act. Failure by the FI to comply with this will therefore constitute an offence under the Income Tax Act. The sanctions are fine not exceeding 5,000 rupees and imprisonment not exceeding 6 months. This leaves the question open as to the sanction for the account holder who is required to but fails to provide the information requested or provides incomplete information. Law doesn't provide for any sanction for the account holder itself, but if a financial institution consistently reports what is termed as an undocumented account, then the MRA may conduct a full audit of the FI's due diligence procedures to assess whether the FI has implemented CRS correctly. We've now reached the third section of our webcast. We will now hear from Ms. Lina Doman-Brett, who is Manager of Policy at the Mauritius Financial Services Commission. What role, if any, will the FSC play in the implementation of CRS in Mauritius?
You will certainly recall that an MOU has been signed between the FSC and the MRA on exchange of information. So it is clear that the FSC will be concerned by the Common Reporting Standard. For example, financial institutions are generally required to carry out due diligence checks, often referred to as AML or KYC procedures. Financial institutions are already required to verify the customer's identity based on documents, data, or information obtained. FIs will be impacted in the sense that the KYC requirements would be enhanced through the introduction of self-certifications by licensees about their tax residency. Do not forget that tax residency certificates are now linked up with FSC, imposing substance rules. The FSC will continue the monitoring of financial institutions whilst ensuring the integrity of the Mauritius financial system and the sound conduct of business in the financial services sector and in the global business sector.
Will the global business sector be affected by the implementation of CRS in Mauritius?
Automatic exchange of information is said to become the most comprehensive and powerful tool to date of all tax authorities worldwide, with approximately 100 countries already signatories or committed to implement and applying this standard. With a view to exchanging information automatically, according to the Common Reporting Standard, financial institutions and relevant global business companies are required to submit their reports electronically to the Mauritius Revenue Authority for onward transmission to the relevant competent authorities. This will require the various stakeholders of the global business sector to put in place the necessary IT platform to carry out the exchanges in confidence with the necessary safeguards. There will also be, of course, a cost element involved. Mauritius is presented as a jurisdiction of substance, where transparent business is carried out. With that in mind, Common Reporting Standards should not adversely impact the global business sector in Mauritius, but rather further strengthen its position as a robust financial services hub.
Is the FSC required to provide information on beneficial owners of global business companies under CRS?
The FSC has already an obligation to furnish information to the MRA to comply with exchange of information requests according to Section 124 of the Income Tax Act. The automatic exchange of information is facilitated by having financial institutions in each participating country collect and report to their local tax authorities relevant information regarding their clients who are resident in another participating country. In turn, the local tax authorities automatically exchange this information on an annual basis with their counterparts in the participating countries. The Mauritius Revenue Authority is the competent authority regarding the implementation of the Common Reporting Standard in Mauritius. In principle, the competent authority can obtain ownership identity or accounting information from the person concerned, public authorities or third parties. In addition, the Mauritius Revenue Authorities has powers to obtain information whether or not it is required to be kept pursuant to the Income Tax Act or any other law. Therefore, information that must be kept pursuant to anti-money laundering laws can be accessed by the Mauritius Revenue Authority. Furthermore, Section 76 of the Income Tax Act has been amended to empower the Director General of the MRA to require any person to establish, maintain, and document such due diligence procedures as the Director General may determine. To conclude, whilst the primary obligation is on the financial institution to do the correct reporting, the Mauritius Revenue Authority has the power to request information from the FSC if it deems that the reporting from the financial institution is incomplete.
Next, we'll have a few words from Mr. Rajesh Ramlal, who is the chairman of the Mauritius branch of the International Fiscal Association. In your view, does Mauritius run the risk of losing potential investors to other offshore financial centers which have committed to not implement automatic exchange but rather bilateral exchange?
I think that the whole point about the CRS is that exchange will become automatic across the board, and bearing in mind, the implementation of the base erosion and profit shifting report, the BEPS report on country by country reporting. This is something that is going to become the standard. So even those which have bilateral arrangements, these bilateral arrangements would stand modified as the CRS would provide. So whether we would lose investment, I would think that where would the investors go? Maybe a question for them of their personal choice. The thing is, when this is going to become the standard, it is just going to be a window of a few months, and maybe potentially maximum 1.5 years. But we should not look at short-termism here. I think the whole thing is more of it's a medium and long term, and there would be no place, as the director of the tax policy of the OECD says, to hide money. The thing is, these investors at the end of the day would still prefer, and I think it is still the case where you will have besides just issues on taxation and issues about exchange of information in relation to tax matters, other criteria which they would decide before going away because of that, because that would not at the end of the day be the clinching factor.
Finally, we went to meet Mrs. Nishi Krishnan, who is the CEO of management company Juristconsult. How will the implementation of CRS affect management companies? What are the main concerns?
A management company, in its essence, is a firm that provides incorporation, registration, administration and management services to the different types of legal entities existing under the Mauritian laws, including investment entities. Investment entities have been one of the targets of the CRS. We will be called in a very near future to assist our clients to determine their classification under CRS and, in the end, advise on the due diligence requirements. We are being asked to become experts on a specific and new issue. The biggest concern with regard to CRS and management companies is whether we have been given sufficient time and enough training to master CRS. Moreover, an entity categorized as a financial institution will need to identify its financial account holders and then establish if they are physically resident in a country with which Mauritius has a tax information sharing agreement, that is, a competent authority agreement. This implies compliance costs being incurred in terms of identification, assessment, control measures, data management, and reporting to ensure compliance. The damaging effect of such exchange of information can be assessed following FATCA, which has caused potential moves of financial institutions to limit their exposure to a non-US client base due to the associated risks and complexities of compliance. This said, the Minister of Financial Services and Good Governance has explicitly reiterated the fact that Mauritius should be promoted as a jurisdiction of substance. CRS should be used to entice those who have money from an unambiguous source or those who are not running away from paying their fair share of taxes to invest in Mauritius. Structures which are built to hide the UBOs, reference here is made to GBC2s or trust, news are that they are likely to disappear with the advent of CRS reporting obligations. If we want to thrive in the financial world in Mauritius or any CRS signatory country, we cannot bypass the reporting obligations.
This is it for today's webcast. If you would like to know more about CRS, please don't hesitate to get in touch with us. I should mention that we also do bespoke in-house training on CRS and FATCA. It's clear that CRS is quite a complex piece of legislation. It is as yet uncharted territory and everything is not set in stone. and things will evolve and boundaries will be pushed and challenges will be raised. Time will tell what the end product will look like. We hope you've enjoyed today's webcast. Please stay tuned for our webcast later this year on BEPS.